Let us start this company form of ownership and this company formation, company types of companies, and this is definitely an interesting to learn because the company has gone through with the different phases and there are different company forms available. And in recent act, Companies Act 2013, the government has also introduced new form of company, which is midway of the earlier partnership form and company. So this become very interesting to understand and to you know cover this particular topic. So as we have discussed that, just to recap, traditionally in India, we have sole proprietorship, which is suitable for small businesses, especially trading and shop level businesses. We have discussed about formation of that and the available sources. Partnership firm is basically two or more than two people who come together to join and agree to share the profit in an agreed proportion. Then company is there, and then cooperative firms. So companies basically earlier before 2013, the companies were of mainly of two types: private company and public company, which is still a general perception about the business, that there comes a private company and there comes a public company. And to my surprise, it is very interesting to know that even the literate class, the known and educated class, does not have the basic understanding about the private sector, private company and public company. Say for example, most of you, when get a job in any TCS company, and when you discuss with your parents and society have this perception that you are doing private job, you are doing job in private company, whereas TCS is not legally a private company. TCS is a public company. And then it comes about the wrong perception when you get a job in BHEL or ONGC type of companies. Then common society understand that you have got a government job. Actually, it is not government job. It is a public company owned by government. So that is a company. That is also a company. So whether you get a job in BHEL or you get job in TCS, legally things are similar. Things are same. What makes a difference, we will discuss in the second part of this lecture. And if your query comes about the difference in doing job in TCS and doing job in BHEL, why the perception differs, then we will discuss. So let us start this particular concept of company. The very basic thing is that when you start a particular business, why you want to choose company as a form of ownership? One thing is that there are limitations with sole proprietorship and partnership firms. Limitations may be that you have limited sources of fund, you have limited management expertise, you have unlimited liabilities. So these are certain points, the drawbacks, you can say demerits of sole proprietor and partnership firms. So you need to understand that you must adapt company form of ownership if your business is expanding. You need huge financial resources, you need professional management to manage activities, and apart from this, the very important thing is, if you want your business to continue even after that means the continuity of operation is not dependent on the person, because in sole proprietorship, It depends on the person. Once person is no more, the business is no more. In partnership, it happens a single partner, if leaves or you know is being removed, then the life of the partnership firm is affected. But in company, it does not have any dependency on the person's life. So you can understand that this says that financial resources, managerial resources, and continuity of the business with the provision of limited liability. This point is very important because in sole proprietorship and in partnership, you have a unlimited liability. Anything happens, it is the responsibility of owners. But in case of company, the liability is limited to the agreed contribution. So liability is not unlimited, liability is limited. So that is why we need to understand, and the common understanding is when your business grows, you require more resources, whether it is financial resources or managerial resources or you know the continuity of business. So you go for company formation. What is a company? A legal definition as per the old act. Old act means Companies Act 2000 1956. It says that a joint stock company is an incorporated and voluntary association of individuals with a distinctive name. There is a different name, different than owners. Say for example, in case of sole proprietorship, Ram Bharose and Brothers, Sitaram Mataram Jewelers. So, the owners and the sole proprietorship or partnership, that was same, associated with that means identity of the firm, sole proprietary firm, partnership firm was associated with the owners. It may be name or owners, accepted or adapted name. But in case of company, it is a distinctive, different than owners. It does have a, why it is so? Because it is a perpetual, it is a separate legal entity, virtual legal person. As soon as the company is registered, it becomes separate legal entity. This point is very important to learn for you. Perpetual succession simply means that you have it is not related to the death of any owner. It is continuity of the business. Limited liability, unlimited liability is not there. In company, you have limited liability, limited to your contribution or agreed contribution or your shareholding. And common seal. Common seal means the company is known in the name of seal and distinctive name. And that seal and name is a legal entity that cannot be, closed down easily. It can be only closed down legally. And usually having a joint capital divided into transferable shares of a fixed value. Now this thing is very important. Shares. Paid up capital is very important. It means usually having a joint capital, that is called paid up capital, divided into transferable shares. In case of private company, these shares are restricted to transfer. It cannot be transferred to anyone. In public company, it can be transferred to anyone. Thus, it is an artificial person created by law. That means you can give birth of a baby, artificial person, a company, but you cannot murder it. You can only close it legally. You cannot harm it, because this artificial legal person becomes a person with all legal rights. So just like you, that company also become a legal right holder, and company can file case against you. It is very simple, just like a person can file. So it can act on its name as a legal person, as a name and seal, and others also can act to it. It is very important to understand this definition, that it is a separate legal entity, sir, common seal, with a limited liability, and there is a paid up capital. Altogether, we will discuss this paid up capital, joint capital, in next portion of our lecture. But it is very important to have the basics. The characteristics of a company, common characteristics as we have discussed, comes out to be from definition that it is a distinctive name, common seal, artificial legal person, separate legal entity. So legal entity is there, it is not associated with the owners. Perpetual succession is there, unlimited life. Life is not limited with the life of owners. Limited liability is another very important thing we have discussed. Transfer of interest is possible. In private company, transfer of interest is restricted. In public company, transfer of interest is open. Professional management. There is a very greater possibility of appointing professional management people who professionally manage the business and separate than owners. It is not necessary that I am managing director, so I can appoint professionals. If I am owner of my company, so I need not required to go and manage day-to-day operations. I can hire professional managers and they will look after. Like, all these public companies like Reliance, Tata, the owners are not doing. They appoint managing director, they appoint the manager, senior manager, AGM, DGM, DM, whatever. And these professional people, they are managing business on the behalf of the owners, that means board. So there is a very importance of differentiation between the board and management. Advantages of the company is that you can understand that there is an unlimited life. Life is not dependent. Limited liability, professional management, large capital resources. Yes, this is very important, because of which the small sole proprietor or partnership firms opt to go for company formation. Recognized legal entity is there. Large scale production is possible. Higher profit. Why we talk about higher profit? Because there is a strategical balance between profit sharing. We will discuss in the last part of your lecture that what is strategical balancing between profit sharing, and that is why company try to keep higher profit with them. If a scale of production increases, obviously the profitability would be increasing. Sometimes it is not necessary that only profitability, loss may increase. Distributed risk. It is not the risk of single person or the limited owners. The risk is distributed to all shareholders. Disadvantages. When you talk about disadvantages, it is simply that company formation is little bit complicated as compared to sole proprietorship and partnership. In sole proprietorship or partnership, it is very easy to form, and the mandatory compulsion, legal compulsion of registration is also not there. Whereas in company, it is legally compulsory to have a company registered, without which your business become illegal. Even in public sector public company, you after registration, you cannot start your business. You can only start your business after registration when you get the certificate of operation of business. Double taxation. This is very talked about issue, and the government is not looking after this particular issue. And most of the academicians and researchers, they do underline this double taxation system. Disadvantage of company is that whichever profit, whichever revenue you get, suppose you invest 100 rupee in a company, just for a symbol, and you get profit of 20 rupees out of that 100 rupee investment business, that 20 rupees is given back to investors as in form of dividend, right? Suppose 5 rupees, 6 rupees, 10 rupees, whatever dividend is given to investors, shareholders back as a profit. Then the company is supposed to pay tax on 20 rupees, and then when that 20 rupees return back to the investor is supposed to give tax on dividend earned. So the same amount is charged twice. The tax is charged twice on the same amount. So this is called double taxation, and this is a very disadvantage of a company, which is sometime government try to address this, but government has not addressed it successfully till date. Another disadvantage is impersonal relations. That means everything is professional. Board is having professional relations with management. Management is having professional relations with managers and employees. They do not have personal relations. Now in this personal relations, in sole proprietary or partnership, the personal relationship matters a lot, but in company relationship is impersonal. You never know that which manager would behave in what manner. So there are chances that professionalism comes, so relationship is sidelined. Separate management from owners, it is very clear, we have discussed. Lack of secrecy. In sole proprietorship, you can understand that single owner. In partnership, there are limited owners, so the business secrecy is among the limited people. But in case of company, professional management is there, so secrecy is very difficult to manage. So it may be that more and more people are aware about your business secret. So that is why we need strategic management, the models to look for your handle for this strategic issues. Now important issue comes about the types of companies. Why we talk about the types of companies? Because before 2013, or rather 2008, we were having only private and public companies as a joint stock company. Private company and public company, right? Now in 2008, another form of ownership was introduced under Limited Liability Partnership Act. Look at, we have the partnership act, the old British ruled partnership act is still running, and you can form partnership firm under that partnership act. But in 2008, government introduced Limited Liability Partnership Act and introduced Limited Liability Partnership LLP. Extension of these type of company is usually LLP, and these LLP, these companies were a midway solution of old partnership and private company. That means you have, as a partner, you do not have unlimited liability as it was in previous partnership. Here your limited liability partnership LLP becomes a company, and this company is a separate legal entity, and in this separate legal entity, partners are bound to liable for only agreed contribution. That means company characteristic comes into this partnership. So this is something different. India introduced at later stage. Some other countries in the globe, they were having this particular types of company, and this company is also a separate legal entity just like any other company. That is why it is categorized into company. I had not discussed this thing with the partnership because it is a form of company as a separate legal entity. This type of firm, being a separate legal entity, is not dependent on the partners. Even if one partner leaves, separate legal entity remains, and whatever solution is available, accordingly this company will run. So type of companies as per 2013 Act, Companies Act 2013, there is a one person company, OPC, limited liability partnership company, private company, which is usually private limited extension, suffix is private limited, and public limited company means suffix is limited, ABC Limited, Tata Motors Limited. Private limited means SB Cars Private Limited, KTL Private Limited. LLP form of organization companies are still not widely available in the open society, which you can understand directly as a LLP. But yes, very soon you will get these type of forms also. One person company, what is this one person company? It is being introduced in Companies Act 2013 first time. A single man can form a company. That means just like sole proprietor. Look at what government is trying to do. Government is trying to make a way between sole proprietary and company, right? With this OPC, government has tried to make a way between partnership and company by limited liability partnership, right? And rest two are already there. This one person company is basically the company owned by a single person. The benefit of this OPC is that under a startup you can have tax holiday for first 3 years. That means first 3 years, if you are registered under Startup India scheme, you don't have to pay tax. This is the benefit of this. But this benefit is not extended to limited liability partners. This is extended only in one person company, because if as an inventor, as a researcher, as an innovator, as an entrepreneur, if you are single person, you want to register a company and you don't want to register as sole proprietor. Say for example, you make a technology business model, right? So it is useless to go for sole proprietary business. Partner, you don't want to make anybody partner. So there was a problem that as a single man, I should be given opportunity to make a company. So government introduced this in 2013 and said that okay, every innovator can register the company in his or her own name, just like a separate company. But it is not a private company, it is not a public company, because to form a private company you need to have at least 2 members, 2 directors. For forming public company, at least you must have 3 directors. So if you don't want to make anyone as a director, you want single man, you are the director, you are the owner, you are the promoter, you are the investor, so you can go ahead with one OPC, right? So under a startup scheme, it is being given 3 years tax holiday. No tax on dividend distribution. Look at the very important case. What we are talking about, that double taxation system, that company is having a disadvantage of double taxation. But in OPC, the government has sorted out this problem, that if you are one person company, so no tax on distribution of dividend. That means if shareholders are investing in your company and you are returning them as a dividend, that means you don't have to, that shareholders don't have to pay tax on dividend distribution, sorry. So single taxation system, that problem is sorted out here, but it is only in case of one person company. Look at the very important issue. In limited liability partnership, we have discussed about this type of private limited company. Private limited company where the ownership transfer is restricted but relatively easy, then this limited liability partnership as a separate legal entity. Tax holiday. Now look at this ownership transfer. In case of OPC, since owner is single person of company, so this single person can sell the company. It is possible. But in case of private limited, it's restricted. Restricted means you cannot sell it in open. Yes, if your private limited company is registered under Startup India, so first 3 years this tax holiday you can get benefit. That means if you are single owner company OPC, after innovation and you registered a company as a OPC, then you will get this benefit. After innovation, if you register a company as a private limited company, then also you will get 3 years tax holiday under a startup scheme, right? So this is a very big boost for entrepreneurship in India, for starters or entrepreneurs. And this was given under Companies Act 2013 and it is continued. Cannot issue shares private company preferred by the investment is mostly by venture capitalists, investors and banks. And these banks, they prefer, these banks, investors, they prefer private limited company because the ownership transfer is quite easy as compared to any other form, limited liability partnership or company. And that is why they prefer private limited, and so that they can very easily take stack of it and they can very easily take over it whenever required. Public company. Public company is basically ownership transfer is there. Voluntary association of members can invite public for investment. That means public investment is there, but private limited company cannot invite public investment. Now let us how to form company. Private company. Under section 2 of Companies Act 2013 defines private companies according to that. Private companies are those companies whose article of association restrict the transferability of the shares and prevent the public at large from subscribing to them. Means article of association specifically mention that you cannot transfer shares and you cannot issue prospectus to invite public for investment. And this is the basic criteria that differentiate between private and public company. Otherwise, rest of the things are same in private and public. Formation of private company can be, now it is simplified pro forma for incorporating company electronically Spike E on Ministry of Corporate Affairs web portal. You simply need to go to your web portal and register your company. Now the government has stopped taking offline paperwork, directly online company formation, and there is a stipulated set pattern of the process. To form a private company, you must have minimum 2 members and maximum 200 members. That means promoters, starting promoters. They can form a company, private company. At the time of formation, there must be at least 2 directors, and the maximum 15 directors are possible in private company. In public company also, there must be 1/3 independent director. This is very important. Now, who are independent directors? I believe that section 149 of Companies Act 2013 very exclusively defines this independent directors. Says that independent directors are those people who do not have direct affairs in form of management or the board. So out of that 15, say for example, if you have 15, so one third means 5 directors should be independent directors. Maybe there's some, you understand that many times companies are appointing some professors of, universities as a independent directors. For example, I can tell you that Professor R.P. Singh of Oil Technology Department is still independent director in some of the companies. I know at least one company I know in Bareilly, independent director. So this is a legal mandatory clause. Private company must have, before registration, must have memorandum of association as defined in section 256 of Companies Act 2013. It defines the constitution, powers and objects of the company. Whereas article of association defines the rules and regulations relating to the business. The way you are going to carry out the business, that is there in article of association. What are the different terms and conditions, rules and regulations? And memorandum of association and article of association both are required at the time of the formation of the registration of the company, private company. Another important thing is that once your private company is registered, you don't need to look for certificate of operation of business. You can, just after registration, you can start your business. Another very important thing is that paid up capital of 1 lakh rupee was removed in 2015 with the amendment in this particular case. Otherwise, earlier at the time of registration of that company, there was a mandatory clause of paid up capital of at least 1 lakh rupee at the time of the registration application, applying for the company. But 2015, the government withdrew this particular clause, keeping in view to promote the startups. Because suppose someone is registering a private company and that person may not have that 1 lakh paid up capital. Subscribed capital means it is also defined in 2013 Act, means paid up capital. What paid up capital means? Paid up capital means the total subscription of the initial shareholding or stock holding in any form. The detail is there in the Act. So now there is no paid up capital required for private company. Public company. Public company under this Act is a company that has a limited liability and offers shares to general public. That means general public can invest in company by acquiring either through IPO or through shares trading on the stock market. And public company is strictly regulated and required to publish its financial health to its shareholders. That means this clause is very important. Since public company takes amount from public, so every quarter they must publish their financial health balance, financial data to the stockholder or shareholders. Formation of the public company is again through that SPIKE on Ministry of Corporate Affairs. Here you need minimum 7 members and maximum no limit. Whereas the minimum number of directors, 3 directors are required. In private company, there were 2 directors. And the maximum is not defined exclusively, but it is 15 directors. 1/3 independent directors, in which the government may specify independent director in case of public limited company. In case of public limited company, the government usually, sometimes government appoints or sometimes government specify that who can be appointed, or you can simply understand that before appointing the independent directors, you must take approval of the government, or you must inform to government about the independent directors. This is again legal, binding. Minimum paid up capital as prescribed time to time by the government. Right now it is 5 lakh rupees for public sector companies. In private it is no more, it is zero. MOA and article of association is again required as per the defined in section 2 of Companies Act 2013. Issue of prospectus to invite public investment is possible in case of public company. So prospectus can be issued by the public company. Private company cannot issue prospectus. This thing is again a very basic, differentiating factor. Another differentiating factor is that the certificate of business commencement needed after registration. In private company, you don't need a certificate of business commencement after registration. Whereas in public company, you need it, because without which you cannot start your business. If you talk about that sources of fund for companies, you can understand that for sources of fund for company, especially we talk about the public company. Sources of fund for public company may be that one is ownership type of capital and another is creditorship capital. Ownership capital comes from issuing preference shares or equity shares. Creditorship capital comes from debentures and bonds. Now, to understand this ownership capital and creditorship capital, it is very important. Ownership, securities, the company can sell the ownership securities through shares, and company can sell creditorship securities through debentures and bonds. Now, what makes a difference in ownership securities and creditorship securities? See, ownership security is when you sell your ownership to the investor, right? So investor become part of management. Once you purchase a single share of any company, you become part of that public company. And you are entitled to interfere into the business, right? So every time the meeting of shareholders is required, and companies are doing this meeting of shareholders, and to take the permission of their ongoing or future projects. But creditorship capital or creditorship securities, when used, like if you sell debentures into market, debentures are having different instrument to collect money in the market, from the market. And in this one, the person who purchased debentures do not have right to participate in, do not have voting right, do not have right to take decisions or participate in decision making. Rather, debenture holder gets the fixed return, and bondholder also gets fixed return. The only difference that why companies are preferring companies are preferring equity shareholders or ownership capital, and companies are not openly issuing debentures or bonds in market. Reason being is that for a company, equity shareholder is the least risk. Say for example, if you invest in shares and company goes in loss, so it is your loss, investor's loss. So owner does not have to take tension, because it is loss of shareholder, preference shareholder or equity shareholder. Because when you have invested in shares, you become owner. So once you become owner, bear the loss. But in creditorship, whether company goes in loss or company goes in profit, debenture holder will get same return. That means it is fixed that okay, 15% or 20% return. So debenture holder will get 15% return, even company is in loss or company is in profit, it does not matter. It hardly matters. So in creditorship, the return is guaranteed. In ownership, the return is not guaranteed. In creditorship, return is guaranteed against the business. In ownership, return is guaranteed against only profitability. If company is in loss, so return is not guaranteed. So for company, this is a preferred one. For investor, this is a preferred one because the money is safe. Even company becomes sick, then also debenture holder will get money back. Bond holder will get money back. So in case of company becomes sick, the priority of the sequence of the priority is that first debenture holder will be paid, then bond holder will be paid. If any amount remains, then preference holder will be paid, and equity shareholder will be the last person to be paid. But if company goes in profit, ownership is at maximum gain, especially equity shareholder, because the return is not fixed. Return is dependent on the dividend. Dividend is decided based on the profitability. So if you have your understanding of business model, you can invest in shares. Then it is, if company goes in profit, you will be benefited. But if company goes in loss, you will be at maximum loss. But in case of loss, debenture holder will be will not be easily affected because his money is guaranteed against the assets. Even the after selling the assets of a company, debenture holder will be paid. So in a way, debenture holder is safe and secure. So this was a snapshot of the company formation, and this was all about of today's session.